The in neckline, on neckline, and thrusting line patterns are important concepts in the realm of technical analysis used by traders to predict future market movements. Each pattern is indicative of a bearish continuation scenario, but they have subtle differences that set them apart. The in neckline pattern is characterized by a two-candle formation in a downtrend. The first candle is a long black candle, followed by a small white candle. The white candle closes just slightly above the close of the first black candle, suggesting a potential continuation of the downtrend. The on neckline pattern is similar to the in neckline, but differs primarily in the closing position of the second candle. In this pattern, the second candle, a white one, closes at or very near the low of the preceding black candle. This close proximity to the low of the first candle hints at a weaker bullish response and points toward the likelihood of the downtrend persisting. The thrusting line pattern also comprises a two-candlestick formation in a downtrend context. Like the previous patterns, it begins with a long black candle. However, the second candle in this case is a white candle that closes well into the body of the first candle, but not above its midpoint. This pattern suggests a stronger bullish attempt than the on neckline, but still indicates that bearish sentiment is likely to prevail. Understanding the nuances between these patterns helps traders refine their analysis and trading strategies. Recognizing the slight variations in the second candle's closing position relative to the first candle provides insights into the market's sentiment and the strength of the ongoing trend. This knowledge enables traders to make more informed decisions in a bearish market environment. The thrusting line pattern is found in the context of a downtrend, signaling the continuation of bearish momentum. This configuration involves a specific pair of candlesticks. The first candlestick is black, indicating a day when the market closed lower than it opened, which aligns with the ongoing downtrend. The second candlestick is white, opening lower than the previous close, but closing within the body of the first candlestick, yet not surpassing its midpoint. Despite the initial appearance of recovery suggested by the second candlestick, the failure to close above the midpoint of the first candlestick's body reinforces the bearish outlook. This pattern suggests that, while there might be some bullish attempts to reverse the trend, the overall market sentiment remains negative, and the downtrend is likely to continue. This observation helps investors to adjust their strategies, expecting that the bearish momentum will persist. The thrusting line pattern is a bearish continuation pattern that occurs within financial charts and is crucial for those analyzing market trends. This pattern consists of two candles. It starts with a long black, or sometimes referred to as red, candle. This candle is followed by a white or green candle. The key characteristic of the second candle is that it opens lower than the closing of the first one, but then closes well into the body of the preceding black candle. However, it is essential to note that the second candle does not close above the midpoint of the first candle's body. This arrangement of candles signals that despite an attempt to recover, the bullish forces were not strong enough to reverse the trend, thereby indicating that the bearish sentiment remains strong. The failure of the second candle to surpass the midpoint of the first candle's body is particularly significant. It highlights that the slight recovery observed is inadequate to suggest a bullish reversal, thus emphasizing the continuation of bearish pressure in the market. Understanding the thrusting line pattern can help investors and traders to anticipate potential market moves and adjust their strategies accordingly. It provides insights into the market sentiment and helps in predicting that the established bearish trend is likely to continue rather than reverse. The thrusting line pattern is a technical analysis concept used to identify trends in financial markets, particularly signaling a bearish continuation. This pattern emerges over 2 days of trading activity. On the first day, there is a long black candle representing a day where the closing price is significantly lower than the opening price, which showcases a strong bearish sentiment. The second day begins with a gap down. However, prices recover throughout the trading day, closing above the midpoint of the first day's candle, but not exceeding the opening price of that day. This recovery on the second day might initially seem like a sign of changing market sentiment towards the bullish side. However, the inability of the bulls to close the price above the midpoint of the previous day's candle signals a lack of strong buying pressure. Consequently, this pattern is interpreted as a bearish continuation pattern, suggesting that despite the temporary bullish attempt, the overall market sentiment remains bearish. This indicates that the downward trend in the market is likely to continue. Traders and investors often use this pattern to make informed decisions about potentially securing their positions or looking for new opportunities to capitalize on the anticipated continuation of the bearish trend. The thrusting line pattern falls under the category of bearish continuation patterns within the realm of technical analysis. When this pattern appears on a chart, it acts as a strong indicator that the current downward trend in the market is expected to continue. In essence, it signals that the bearish sentiment, or the dominance of sellers over buyers, maintains its grip on the market dynamics. This pattern is identified by specific features on the candlestick chart, which is a popular tool among traders to visualize price movements. The thrusting line pattern occurs during a downtrend and is marked by a particular formation of candlesticks that suggests a temporary struggle or pause in the downtrend, only to be followed by a confirmation that the sellers are still in control. Understanding the significance of this pattern is crucial for traders and investors, as it helps them make informed decisions about their positions in the market. Recognizing a bearish continuation like the thrusting line provides a signal to refrain from making new buys and consider strategies that benefit from a decline in prices, such as holding or increasing short positions. In summary, the appearance of the thrusting line pattern on a chart is a presage that the downward trend is likely to persist, reaffirming the dominance of bearish sentiment in the market. This insight is valuable for market participants looking to align their trading strategies with the prevailing market trends. In confirming the thrusting line as a bearish continuation pattern, 2 key factors play a vital role: volume analysis and the formation of subsequent candlesticks. When a thrusting line appears, an increase in trading volume can strengthen the signal that the bearish trend is likely to continue. This is because higher volume indicates stronger participation and commitment from traders to the current direction of the market. Moreover, the presence of continued bearish candlesticks following the thrusting line further confirms this continuation signal. These subsequent bearish candlesticks show that selling pressure remains strong and that the downtrend is still in control. Therefore, both an increase in volume during the appearance of the thrusting line and the formation of additional bearish candles are crucial in validating the pattern as an indication of ongoing bearish momentum. The thrusting line is viewed as a bearish continuation pattern, indicating that the current downtrend in the market may continue. However, Its ability to accurately predict future market movements can significantly improve when combined with other tools and indicators from technical analysis. This reinforces the importance of adopting a holistic approach to trading decisions. Technical analysis is a method used to evaluate securities by analyzing the statistics generated by market activity, such as past prices and volume. Various tools and indicators are at the disposal of traders, including moving averages, relative strength index, RSI, and Bollinger Bands, among others. When the thrusting line pattern is observed in conjunction with these other indicators showing similar bearish signals, it can provide a stronger confirmation of the market's direction. For example, if a thrusting line pattern forms and the RSI shows that the stock is still in an overbought condition, this concurrent indicator can lend additional credence to the expected continuation of the downtrend. Similarly, if moving averages indicate that the long-term trend is bearish, the presence of a thrusting line pattern aligns with the broader market sentiment, increasing its reliability. This synergy between the thrusting line and other technical analysis tools emphasizes the value of an integrated analytical approach. By considering multiple facets of market data, traders can make more informed decisions, potentially enhancing their trading strategies' effectiveness in predicting future market movements and managing risks. Combining the thrusting line pattern with the relative strength index, moving average convergence divergence, or support and resistance levels can enhance a trader's understanding of bearish market trends and potential areas for market reversals. The thrusting line pattern, recognized for signaling a continuation in bearish markets when analyzed alongside these technical tools, offers a more comprehensive view. The relative strength index, a momentum oscillator that measures the speed and change of price movements, helps traders identify overbought or oversold conditions. When a thrusting line pattern appears alongside an overbought signal on the RSI, it may reinforce the bearish continuation signal. The moving average convergence divergence, on the other hand, tracks the relationship between two moving averages of a security's price. A bearish signal from the MACD can confirm the bearish momentum suggested by the thrusting line pattern, providing traders with another layer of validation. Lastly, support and resistance levels are key indicators for the price limits within which a security tends to trade over a given time period. When a thrusting line pattern emerges near these levels, it can indicate the potential for price to resume its downtrend after testing a support or resistance level. Integrating the thrusting line pattern with these tools allows traders to analyze market conditions more effectively, offering clearer insights into potential future movements and enhancing their strategies in navigating bearish markets. This approach enables traders to make more informed decisions by considering multiple aspects of market behavior. A common mistake people often make is interpreting the thrusting line pattern as a signal for a bullish reversal because they notice a white or green candle, which typically indicates buying interest or a potential upward movement. However, this interpretation misses a crucial aspect of the pattern, which requires an understanding of its development within a broader market context. The thrusting line pattern appears during a downtrend and is characterized by a specific candlestick formation. After a day of trading that results in a black or red candle indicative of a price decrease, the next day begins with a lower opening but then closes significantly higher, creating a white or green candle. While this might appear as a sign of reversal at a glance, the key to correctly understanding the pattern lies in the candle's inability to close above the midpoint of the prior day's candle. Recognizing this pattern's context is essential for accurate interpretation. It suggests that despite the buying pressure that led to a higher close, the market could not sustain momentum to overcome the bearish sentiment fully. As a result, the thrusting line is considered a bearish continuation pattern, hinting that the downtrend is likely to resume. Investors and traders should carefully consider the pattern's attributes and the surrounding market conditions. This includes looking at volume, price action on subsequent days, and other indicators to confirm the pattern's implications before making investment decisions. In doing so, individuals can avoid the common error of misinterpreting the thrusting line pattern, helping them make more informed and strategic trading choices. Traders often use the thrusting line pattern as a signal in the stock market, especially when they are considering bearish outcomes. This pattern points to a continuation of a downward trend, making it a valuable indicator for those looking to reinforce or enter into short positions. To put it in simpler terms, when traders see this pattern, they might think the price of a stock is more likely to go down than up. So, how do traders act on this information? They might choose to sell a stock short if its price drops below the lowest point of the white candle in the thrusting line pattern. The white candle represents a brief moment of upward movement in price, which is quickly overshadowed by bearish sentiment. Selling short means they are betting that the stock's price will fall further, allowing them to buy it back at a lower price in the future and profit from the difference. To manage the risks associated with short selling, traders can set exit points or stop-loss orders. These are predetermined points at which a trader will exit a position to minimize potential losses if the market moves against their prediction. In the case of the thrusting line pattern, an exit point might be set just above the highest price within the pattern. This acts as a safety net, ensuring that if the market suddenly shifts in an unexpected direction, the trader's losses are cut off at a manageable level. In summary, the thrusting line pattern is a bearish signal that can guide traders in making strategic decisions to sell short and manage risk in a declining market. By setting careful entry and exit points, they can look to profit from anticipated downward movements while protecting themselves against unforeseen market shifts.